Good morning, ladies and gentlemen. Well, we are here. We are at the 0.382 retracement of the whole move in the bonds and what would seem to be another failure of the Trump reflation trade. The 5-year note is still a little bit away from it, but the 10-year has absolutely nailed it. We are now at a very important inflection point in the market. If the market now continues lower, which is what people least expect, it lower in yield, there will be some consequences for the risk on, risk off parameters. But for the time being, our best call is that we go up and down within this range around the 1655, so 165 in yield in the 5-year note, and especially in the 10-year note. There will be battle royal around the 210 area in 10-year notes. As you can see by comparing and contrasting the 5-year and the 10-year, the flattening trend shows absolutely no signs of abating. Most of the flattening is actually coming from the 30-year note, which still has an objective, we would say, around the 157 area. So we are better buyers of 30-year notes and better sellers of 2s and 5s still. That trend shows absolutely no signs of abating, and we don't think it will until sometime later this week, when people start squaring up ahead of the FOMC meeting, which will take place on Wednesday of the week after this. Here we have a chart of the 5-year note yield minus the 30-year note yield, and we can see that we are fast approaching the 105 and then the 102 level, which has never been broken since the basically the reflation of 2009. If we break 1% on the 5-year to 30-year yield, that we think is going to be extremely significant. There will be something that we can't yet appreciate, which is going on in the background. We will be watching these areas exceed, very much so over the course of the next few weeks and months. If 1% goes in the 5s, 30s, we think that that will have huge consequences for risk on and risk off, and actually it will presage something that we have no idea about. Why should that be happening? We have no idea, but something very, very big will be going on if 530s break the 1% barrier. In Europe, we have been almost spot on. We've told you, don't get short. There is no reason. This is now the Schatz, the 2-year on a weekly. As you can see, it will probably come in and fill these gaps around minus 75, minus 80. Again, nothing to be done here. It's a market which is so neutral. It has probably entered the doldrums of summer already. The bobble, the 5-year, it is doing much the same. It has filled this gap. It'll now probably come. It's basically just following what the treasury market is doing, but to a lesser degree, and that is why we keep on seeing pressure on the euro upwards, because for every 5 basis points that treasuries come in, the Europeans come in 2 or 3. So basically, bunds at the moment are treasuries light. the spread comes in as the treasuries move as opposed to as the bunds move. There is no reason for the bunds to move. They're quite comfortable in this range, and you can see we've had 4 weeks straight of down yield from from -27 to -44. Yields keep on going more negative, and in the German Bund, again, yields have gone from 45 basis points to about 27 basis points. We don't think they will go very easily through -17, -18, and that will be a level where we'll be very keen to play, even if via options. We think if we can get short of bunds around -18 yield, it'll be very much worth while doing so. And here we have the 5-year note yield against the dollar index. And it's really amazing how sometimes these markets achieve convergences to very important levels all together. And it just shows you how the markets are interconnected. Here we have the 5 and the 10-year note achieving the 0.382 retracement and the test of the 200-day moving average, while the dollar index comes back to 96.50, which has been its magnet for the past several years. From these levels, we think, just as we think there will be reactions in the bond market, we think it's more likely to stop everyone out, get everybody short, and then go and retest the 200-day moving average at around the 99 level and test it from the downside, fail, and come off. So these markets, the treasury market, the bond market, and the dollar index, all interrelated and all basically achieving what we thought they would, and now being at very critical levels. Behavior here will determine the behavior of these markets over the next several quarters, because if the bonds, after having rebounded a bit in yield and the dollar index having rebounded a bit in yield, fail at the 200-day moving average, and these fail at the 50-day moving average and then come back and fall through, we will have a massacre in the dollar index and a massacre in yields. All this will be a sign of a very important risk-off event which cannot not be reflected in equity prices. We really need to talk a little bit more about the risk-on, risk-off position at the moment. This is a chart of SPY over TLT, so basically a chart of S&Ps over the long bonds, 20 to 30 year bond area, TLT. As we can see, last week we had absolutely no movement. We had no movement because both bonds and equities rallied at the same time, and their relative position at the end of the week was much the same as at the beginning of the week. So we had absolutely no movement. You would have thought in a week where bonds rallied so strongly, you would have had a risk-off move. You haven't. So this indicator is telling you that we are still very much on in a risk-on move. We don't have any risk-off indication from this extremely important ratio. And as you can see, this ratio has been rallying along these trend lines since 2009, since we made the bottom. We have been rallying very nicely. We told you several weeks ago that 188 was going to be an extremely important level. That was the level, the low of this year, and also will be the level which will be caught by these trend lines. If that goes later on in the year, we will have, well, a bit of a crash. We will definitely go and retest this 160 area, which will probably give you a move of at least 10% in the S&Ps. It's going to be quite interesting. But at the moment, it's not telling you anything. Absolutely nothing. Let's now just have a look at some other risk on, risk off parameters. Out of all the risk on, risk off parameters, this is probably the most worrying. This is HYG, which is junk bonds, over TLT, which is the Treasury's 20 to 30 year area. And they have been in a descending trend ever since the bounce in 2009. They recovered, as you can see, in 2009, and then since 2010 it's basically been a continuous swoon. We rallied from a position last achieved in 2009 at the depth of the crisis in early 2016, and we started rallying, and finally we had the Trump rally in here in November of last year. And ever since then the market has been doing absolutely nothing, and in fact now it is testing the lows made for the year. We still have the 200-day moving average holding it, but we are actually very close to making new lows on this move. This will be something that will be very worrying, and one of the first indicators that we are beginning to lose the support of the credit spreads. Credit spreads, in our opinion, tend to be at least 6 months ahead of any turn in equity prices. If you see credit spreads being in trouble, you can be sure that stock prices will be in trouble at some stage over the next 3 to 6 months. We are watching this very carefully, and it actually does not surprise us that this is the worst risk on, risk off indicator, simply because the risk on which is going on at the moment is concentrated in such few stocks that the majority of stocks are being eroded while a very small minority are rallying and pushing up the indices. Just for emphasis, here you have the high beta stocks of the S&P against the S&P itself. If you have a real true risk on move like you did in the beginning of 2016 and like you did in November of last year, you will see this ratio going up. Here all year it's done nothing but go down. You cannot have a long-standing rally in equities with high beta going down. That just indicates that there are so many names that are basically giving up the ghost and not making anywhere near new highs with the indices. So this is an index rally. It's not a stock market rally. It is not a stock rally. It is basically an index rally, which is just contained to very few names that we know of. We know Google, we know the FANGs, we know Amazon, and that is the names that are pushing up the index as opposed to the vast majority of stocks. This is a chart of XLF, which is basically the financials, and that is approximately 20% of the stocks in the S&P 500. You can see that they've done absolutely nothing all year. They tried to rally, they came back. We still insist and are absolutely certain that the key to the next move in the indices is in XLF. Not because it's just such a large component of the index, but also because it has this very unusual pattern in both the hourlies and daily moving averages and Bollinger Bands. It has been constricting for days and days. It has basically all the moving averages within 10 basis points of each other, which is per se very unusual, and you have this 200-day moving average fast approaching the current price action. We have been thinking that this market should break down for a long time. We know where we want to be in. If it breaks 2286, we want to be in. 2324 is also a level where you can look at it from the short side to basically play within 23, 24, 2286. But that is not as interesting as what will happen if it starts breaking higher above the level of 2370. If we have several closes above 2370, this market should fly to new highs and take the index much, much higher. If we have a 5 to 6% move here, it would be not unreasonable to expect at least a 1 to 2% move in the S&Ps per se, therefore taking the S&Ps up into the 2470s, 2480s just by the power of XLF. So we will be watching these levels extremely carefully. Any close now above 2365, 2370 indicates that the downside, and don't forget that everybody is looking at this as some form of head and shoulders and anticipating a break. If that doesn't happen, the converse will happen. Markets that don't go down go up very, very fast and stop everybody out. People will not be stopped by just a move through 2360. They will probably have stops around here, 24, 2420. Those will be taken out and we will just fly. But that is to be determined, because our favored indicators in the XLF and the yield curve show us that the XLF is walking on air. What could very easily happen is that we now have a retracement in the yield curve over the course of the next 2 or 3 weeks, and that would actually be caused by the Fed not tightening. If the Fed were to, or giving signs that it has done all the tightening it's going to do for the foreseeable future, in that case the yield curve could steepen again, and in that case we could see XLF taking off to the upside. So that is what these charts are telling us, but for the time being, until XLF starts breaking the 2360-70 area and we see at least signs of stabilization in the yield curve, we cannot be positive of XLF. We can't put our money there. So what we would say is play with options. Options are exceedingly cheap, even in XLF. 2350 straddles for the next 2 or 3 months could be very, very profitable. We will have a look at those next week and tweet you what we think about those. XLF will definitely be the market to watch over the course of the next couple of months. Well, in our biases, we have nailed it almost to the tick. This is 119.03 and 126.30 in the 5-year and the 10-year note. We're there. So now what the reaction is going to be all important. We think there will be reactions both to the downside and to the upside. There will be a battle royal at this level. We will have big funds trying to put on short positions. We have Double Line, who has absolutely indicated that he will go limit short of treasuries around the 210, 215 area. Well, let's see him do it. And we have some other people who are convinced that we're going into a new recession in the States and they will be piling into bonds to take advantage. So there will be a battle royal here. We don't expect it to be resolved in the next few days. We expect it to be possibly resolved after the Fed comes out and does what it will in about 10 days time. Until then, we see a period of volatility in 5 and 10-year notes, up and down around this area, with neither side being able to force a conclusion or basically preempt what the Fed is going to do. It's only after the Fed has spoken that we should expect a conclusion to that battle one way or the other. Bunds and Bobble will just follow what the 5-year note and the 10-year note are doing in the States. As we told you, shorts have poor risk reward, and they continue to have poor risk reward. While the treasury market is rallying, there is absolutely no reason to play Bunds and Bobble on the downside. Those levels are very clearly indicated. We told you what the yield level was, around 15 to 17, 18 basis points in the Bund. Only there should you get excited about the downside. Commodity indices keep on making new lows. What reflation? There isn't any, and that is why the treasury market is so buoyant. Now ES, we don't think it has anything in the tank until XLF starts moving it. 2370, as we just indicated, is going to be a very important level, and above 2410 it will be in full trend. We will have look at options in XLF next week. 2350 straddles could be very, very profitable over the course of the next 2 or 3 months. NQ is still the only trending sector, but it's so overbought that to buy it here, it's almost suicide. The Russell 2000 has begun to be the new leader. If it can close a new all-time highs, we think it will be the new leader in the equities, but that would actually mean that SPY, IES and NQ take a back seat, and Russell 2000 is the one that moves upwards. The super cycle is still with us. Emerging markets and EU against US stocks are very stable, even while US stocks are rising, which indicates to us that at some stage over the course of the year they will make a brutal move higher. We still very much favor emerging markets and EU against US stocks. Apart from XLK, we will always think that the future, it belongs in the States, i.e. technology, and we will not short XLK against emerging markets. We will short things like XLI against emerging markets, but certainly not XLK. Emerging markets are still in trend against developed markets, and not even Brazil has changed that fact. DX, as we told you, that 96-50 area is going to be very important. We expect a rally back up to 99 as the battle between bulls and bears in the treasury market takes place. But finally, we expect the DX to be much, much lower in 2 to 3 years' time. Thank you very much indeed, and speak to you all on Monday.